G'day folks, welcome back to another review of the world stock markets. Now the charts were showing a bit of a dump in the last few hours of trade on Friday. So we'll look at, is that something bigger to come or just a little bit of a glitch in the upward momentum? We'll have a look at the charts in a moment. Don't forget also we look at plus one videos. We do post those occasionally and they sort of dig deeper into our strategies, and we do review other strategies as an option for you to consider. So as of today, August the 4th, the S&P and the Nasdaq, the outlook for the US markets is cautiously optimistic, while strong corporate earnings and the continued growth of the AI sector are providing support. Recent weak job reports have sparked concerns about the economy. Volatility is expected to increase in August and September as markets respond to a possible Fed rate cut and shifting sentiment around the new US tariff policies. The German DAX continues its strong upward trend, having surpassed a key psychological level. This performance is supported by a robust German economy, lower energy prices and continued ECB rate cuts. However, a short-term correction is considered overdue as the market has been on a sustained bullish run. The Japanese Nikkei outlook is driven by domestic economic recovery and supportive corporate earnings. While the Bank of Japan's cautious approach to rate hikes provides a positive environment, potential risks include a sharp increase in government bond yields and the impact of new US tariffs on trade. The ASX 200. The Australian market is navigating a mixed landscape. Strong commodity prices, particularly for copper and iron ore, are benefiting the mining sector, which is a significant component of the index. However, the ASX is entering its full year reporting season, and the performance of individual companies will be a key driver for the market's direction. And lastly, for the China Xinhua, the China market's outlook is marked by government support and a focus on high quality growth. Monetary policy expected to remain moderately loose to support domestic demand. While a prolonged trade war with the US poses a risk, the government's comprehensive regulatory measures and investment in high-tech manufacturing are aimed at fostering long-term economic resilience. So looking at the ASX first, on the monthly, we always look at the long-term trends first for those new to the channel. You can see here the price is still above the moving averages, and the CCI likewise, although it's starting to pull back there. And I've identified these fair value gaps here, and very likely the price will retrace back towards those areas to fill those orders. Also, we do have a bearish divergence, lower highs on the CCI. In fact, if you extended that to that point there, and that trend line to there, you can still see it's a declining CCI peaks versus higher highs on the price. That's a bearish divergence. And I've marked here a target for a divergence range on the downside. That goes back to about that area there. If I drew a Fibonacci from that high to that low, that identifies that area there. Just adjust that slightly. That 23-38% range is our minimum target. It could actually fall a lot further, or could just touch it and bounce off that, but that's what we're looking at initially as a initial minimum target. On the weekly, we do have a somewhat of a neutral positioning at the moment. The CCI is in that moving average range, giving us a neutral positioning, even though the price is above the moving averages. So mixed signal there. Plus we've got another bearish divergence there in the short term. So just be aware of that. We might see a bit of a retrace to the downside, creating a bit of a flag there on the weekly. And on the daily for the ASX, it's hit this resistance up there at 87.87, and it's been fluctuating, consolidating there for a while now, although it's actually finally broken through since our last video below that moving average range. Likewise, the CCI is below the moving averages, giving us a bearish momentum. So if you're trading on the hourly, you go in the direction of the daily. Now you'll notice here as well, we've got a fair value gap. This hasn't been filled yet, so we might see a bit of a retrace to the upside to fill those orders before possibly falling further to the downside. You can see back here we had a few fair value gaps. They've all been filled with the subsequent candles. Now if we go to the 1 hour chart first, so even if you're trading on the daily, we look at the lower time frame for any micro moves, and what we're looking for is any divergence. You can see back here we had a bearish divergence, and that broke down quite strongly, but at the moment that CCI is moving in line with that price. That could possibly be a double top on the price there versus lower highs on the CCI, but I won't mark it because strictly that is slightly lower. So strictly speaking, it's not a bearish divergence. But at the moment, it looks like it's moving okay. But again, avoid going long until we see the daily break to the upside on both the price and the CCI. Now, in terms of back testing, I've got the long positions here for the stop loss approach and the average down approach. And they started back here around about this period when the price broke above the moving averages, and so did the CCI. You would have gone long during that period on the 1 hour time frame. Now, as you're going through this period, the take profit is a 0.3% gain, and a stop loss for the stop loss approach is a 0.5% stop loss, and the average down approach is the same take profit, but instead of stopping it on a downside, you average down. Now, having said that, you do want to follow the basic rules, go in the direction of the higher time frame, but also stop it when the higher time frame breaks into the moving average range of the CCI. So at the very latest, you would have stopped it at that point there, which is equivalent to this area here on the 1 hour chart. Also take note of these bearish divergence on the 1 hour time frame. So if you see higher highs on the price, wait for the moving averages to start turning down like it did back here, for example, and you would have got out of the trade. Wait for both those moving averages to start curving up to take more long positions. And I have deliberately zoomed out here because it's better to sometimes take a 50,000 foot view so you can see these moving averages more clearly in terms of their direction. So again, avoid going long when the price goes against you and take long positions when the moving averages start going in your favor. So for the China Xinhua market, on the monthly, first off, the moving averages, the price above the moving averages there. So bullish momentum. Likewise, the CCI, it's a fresh breakout to the upside. So if you're trading on the weekly, go in direction of the monthly, going long only. On the weekly, we do have a break above the moving averages as well, bullish momentum, but notice the CCI is touching that moving average range. So avoid going long, and you should close out your positions if you're going long during that period. Now, in terms of, we had a bullish divergence back here, higher lows on the CCI for the weekly versus lower lows on the price, and that broke up into our minimum range of 23-38% range. It went actually a bit higher, and it pulled back into that range again, and currently it's continuing just in that range. On the daily, it's actually broken below, as we said from last week, had a pretty strong downside, broken below the moving averages, giving us a bearish momentum, and the daily CCI is also below the moving averages, giving us a bearish trade. So going only short on the 1 hour time period. If you look at the 1 hour period here, let me just go back to the naked chart first. So again, going short based on the daily. So you would have taken the short position at one of those candles there when it broke below the moving average, and the CCI was below as well, and you would have had a couple of nice little trades there. Now you would have closed it out during that period there. Notice there the CCI touched the moving average band and started curving higher, so you should have got out of the trade somewhere in that range there. Now yes, the price did continue on a downside. You can actually trade according to the moving averages of the price, but more often than not, the CCI breaking into that moving average range will give you a better exit. In this case, it didn't work that way. So at this point, we've got a bullish divergence. So if you are going short, you should have got out of the trade already with a break above that moving average range. But also notice we had a bit of a heads up back here with the higher lows on the CCI. So if you draw a trend line there, higher lows versus lower lows on the price. That was a bullish divergence and eventually broke higher than that moving average range, and that would have been your entry for, or not to go long, but to confirm the upward momentum. But at the moment, based on the daily, you want to be taking short trades only. So wait for this, if it does, to break to the downside on both the price and the CCI to take more short trades. Now, in terms of a back test, going long again, starting back here around about the 15th or 14th of April. That was back in this period here. Now, in this case, you would have closed out your positions once the price and the CCI broke below the moving averages. You would have got out of the trade at that point there, and that would have avoided this drawdown. So I've deliberately left this in here for long positions to show you the effect of the drawdown. It just stayed in the trade. So always pay attention to the daily, even if you're trading on the 1 hour time period. But also note as well here, we had a couple of, if you're going long, we had a couple of bearish divergence. So you would have got out the first time at that point there with that bearish divergence there. Maybe got into a long trade there, then got out of it again there. Avoid going long during that downtrend on both the CCI and the price. Gone long again during that little period, and then close it out again there, and you would have avoided that drawdown, as I said. And that's basically the strategy we follow. So at the moment, as I said, watch this bullish divergence, and it looks like it's going to break further to the upside. And in terms of drawing, let me go back to that other naked chart. In terms of drawing a target range for that, we draw a Fibonacci from that low to that high. You can see there it's already hit the 23-38% range. Now this could just start pulling back towards the downside, but the CCI is not showing that yet. It looks like it's going to take further upside, and we don't know how far it's going to go. I don't trade these divergence. I look at them as a potential area for reversal if you're going, in this case, if you're going short during this little period. That would have been an early warning signal to close it out, like I said, at that point there. So the German DAX is doing pretty nicely at the moment, still very bullish on the monthly, although it's got a red candle so far this month. And notice the CCI has broken into that moving average range. And also we've identified this fair value gap, which hasn't been filled yet, so they're unfilled orders, and very likely we're going to see the price come down to that area. Don't place short orders based on that. I'll look at it more of a potential reversal support area, if you like. There's another bigger fair value gap right down here. It's a very long-term play. This could take years to play out, so I don't go placing short orders, but again, just something to be mindful of. But at the moment, I'd say neutral positioning on the monthly based on the moving average movement. On the weekly, it's hit this resistance, bouncing off that resistance at 24,640. Notice we had a couple of bearish divergence here. The first one hit that target range identified there. And this other one here, we've still got another bearish divergence. I haven't marked the trend lines yet on those ones. Higher highs there versus the same period, lower highs on the CCI there. So that's a bearish divergence. And if I was to draw a target range on that, go from that high down to that low, you can see there it's not far off the target. So if I was to draw a target range at 23-38% range, that's a minimum. That's where I expect it to break into that range, which coincides with those moving averages. Also note we've got these fair value gaps down here which haven't been filled yet, so very likely we're going to see further downside, and the CCI is showing no sign yet of a pullback. On the daily, it was also broken to the downside with a bearish momentum, but do note we've got a bearish movement on the price as well as the CCI. Got a slight move to the upside on the CCI with those bullish candles so far this week, and also notice these fair value gaps right up until this point up here. So it's partially filled about a quarter of that already, and looks like it may further go up towards these moving averages. So again, just be cautious of that. Don't go placing long orders. Again, we go in the direction of the moving averages predominantly. On the 1 hour period, so even if you're trading on the daily, we look at the 1 hour period for any micro moves, and what we're looking for is any divergence. And this one, the CCI is moving in line with the price, the highs and lows, so there's no divergence to worry about there. That was possibly a double top there on the price versus lower highs on the CCI, bearish divergence. That pulled back. You can see there if you drew a Fibonacci in that range there, it pulled back to about 100% retrace. In terms of a back test on this one, again going back to about the 16th of April, back around this period when the daily broke above the moving average, and so did the price in the CCI, you would have taken long trades, and you would have got out of the long trades along that period there, watching closely on the hourly. If you're trading the hourly, you can see that the stop loss approach was doing quite nicely, and following the advice of breaking when a price goes against you on the daily, you would have closed out your positions and you would have avoided these drawdowns on the stop loss approach, but also the average down approach. So these are usually avoidable, so always pay attention to the daily movement in those moving average ranges. Again, we had quite a few bullish and bearish divergence in those periods until currently where we are at the moment. As I said, you would have been going short predominantly during that period. So for the Japanese Nikkei on the monthly, first off, the price is above the moving averages, giving us a bullish momentum, but the CCI notice has been falling off and currently in the moving average range, so giving us a neutral positioning. So somewhat neutral at the moment. I wouldn't be going long or short until, if you're trading on the weekly, until we saw the monthly break either higher, in which case it would probably break above that resistance, or lower below those moving averages of the CCI. Also notice these very long-term fair value gaps haven't been filled yet. Just be aware of those. Those partially or mostly have been filled, but this one down here hasn't been. So if it breaks through this area here, we're going to see it come down towards this simple moving average 200 around the 20,500 mark. Again, that could be a major event that could unfold in the world with geopolitics, but again, we don't know when that will happen. Just be aware of that. On the weekly, bullish momentum on the price, but notice the CCI is just about to touch that moving average range, giving us a potential neutral positioning very soon on the weekly. Again, notice these fair value gaps down here. Again, long-term play, don't go placing short orders. And on the daily, we had a pullback since the last week, broken below the moving average of the price and the CCI, but notice the price today so far is breaking into that moving average range, looking like it's going to fill this fair value gap, and about half of it is filled already, and most of that has been filled as well. Now if we go to the 1 hour chart, looking at the micro moves, we did have a bearish divergence back here, and that pulled back quite strongly, But also notice, very importantly, we had these fair value gaps that I identified back here. And on our last video, this one was about a quarter filled, and this one since then has dropped down to almost 100% of that range as well. So always pay attention to those fair value gaps that I identify. And again, here's the daily chart again with those fair value gaps down there to be aware of. In terms of a back test, again, I started it back here when it broke above the price and the CCI, above the moving averages, the stop loss approach, and the average down approach. Now again, paying very close attention to when they touch the moving averages of the CCI on the daily, but also paying attention for any bearish divergence on the 1 hour time frame. You can see here you would have let that run as it was going higher on the price, but as soon as you saw that second peak on the CCI, you would have closed out your positions once you started seeing a decline on the price moving averages as well as the CCI, so you would have got out near the top there. Avoided going long during that little period there. Again, notice I've got identified some little fair value gaps. Again, notice I'm not zooming in too closely because sometimes you want to be able to see the bigger picture, and sometimes looking at it this way is a lot more effective than zooming in too close because you might get exit the trade prematurely or miss it altogether. So you want to make sure you're following the general trend of those moving averages. So if you haven't already seen it, I did a video on the S&P 500 long term with all the divergence that have impacted it over the past 30 odd years. So I suggest you have a look at that video to get an understanding of how to read divergence in more detail. So let's go back now to the current status of the S&P 500 and where it's potentially leading us. So at the moment on the monthly, we've got a bearish divergence on the S&P, but notice the price is still very strongly above the moving averages, even though the CCI has broken into that moving average range. Again, notice these fair value gaps, so we're very likely going to see a break to the downside in the near term. This could take months or even years to play out necessarily, but just be aware of that. But also in terms of this bearish divergence, that's that blue rectangle of it identified there as a minimum retrace, and we may see it break into that range. Again, this could take months or even years to play out, depending on how and what happens in the geopolitics of the world. On the weekly, we've got a little of another bearish divergence here. This started around about the end of 2024 and currently is still in play, declining CCI versus higher highs on the price. Again, another fair value gap there. So you might see the price break into that range very soon. So somewhat neutral positioning on the weekly. On the daily, bearish momentum. Both the price and the CCI broken below the moving averages. But again, notice short term, we've got this fair value gap. Hasn't been filled yet. It's about a quarter of it filled so far. And we may see further upside before it possibly breaks further to the downside. There's another fair value gap here on the downside, so just be aware of that. And also longer term, we've got this bearish divergence target down here. In terms of the 1 hour time frame, looking at it in micro moves, we had a bearish divergence here, lower high or double top if you like on the CCI versus higher highs on the price. That broke down. And in terms of bearish divergence, that hit our target very quickly in that rectangle there, the 23-38% range, before falling further. And currently you'd be taking short orders based on the daily's trend, with the hourly also breaking further to the downside if you're trading the hourly. Now at the moment the CCI is moving higher, and so is the price, so just wait for that to break to the downside if it's going to continue on a downward momentum. But as I said, in regards to the daily fair value gap, it might actually rise a bit further to fill those orders on the daily possibly. Now in terms of the current situation with the bearish momentum, you would be taking short trades. That's where I identified the stop loss approach here and the average down, and they're both giving us the same result, 1276 in terms of returns if you're going short from that period back there. And you should have closed it out probably once at that point there when it broke into that moving average range, and then re-entered it there, and then closed it out again on that candle near the bottom there. See what I mean by CCI gives you often a lower point to exit rather than waiting for the price to break into that moving average range. So always follow the CCI as the main driver of trend. So this is the Nasdaq, the last chart we're looking at. So here on the monthly, bullish momentum at the moment, price above the moving averages. But again, notice we've got a neutral positioning on the CCI and a bearish divergence. And that could be the start of that bearish divergence playing out. But also notice we zoom in, we've got these fair value gaps with price hasn't reached those areas yet, so unfilled orders. So possibly breaking into those areas if this starts turning down soon. On the But at the moment, bearish divergence there, plus these other fair value gaps here. On the weekly, another bearish divergence, lower highs on the CCI versus higher highs on the price. Again, that's a very long-term play. And again, notice these fair value gaps down there hasn't been filled, and this one and that one as well. So again, it may possibly break if something happens in the world geopolitics to be aware of. In terms of a daily, if I zoom in for a moment, we did have this, you notice here, almost a flat top on the CCI versus that point there versus higher highs on the price. I'll readjust that, and that resistance should also probably go up there as well. It's been adjusted. So again, a bearish divergence there. Price has broken through the moving average range, so is the CCI. It's taking bearish trades only. Again, notice here we've got a fair value gap that's starting to be filled, and back here we've got longer term, we've got these bearish fair value gaps on the downside as well, so just be aware of those. Going to the 1 hour chart, so taking short trades from where we are at the moment on the daily. If you're trading on the hourly, the CCI is broken below the moving average range, and so is the price. And taking short trades there, you would have closed out the first one on that candle there, and then reopened it on that little candle there. So almost a sideways move, but no gain or loss on that one. So nice little trade there, and then enter another position there. Let it go. Close it out when the CCI touches that moving average range. Again, notice how it closes it right near the bottom. And more often than not, it does that as opposed to waiting for the price to break into the moving average range to exit your trade. Also, for the back test, we've gone back to this period when the price and the CCI broke above their respective moving averages, stop loss approach, and the average down. Notice the stop loss approach has had a more of a drawdown during this period because of these declines. And notice again, zooming out at this level, you saw these bearish divergence, and you would have got out near the top of that one there. So that was going pretty much sideways. You would have taken small little trades going along and closed it out when you see the daily break to the price, or the CCI break to the downside. Again, very cautiously going long only when the daily CCI and price are above the moving averages. Remember, don't forget to reference the +1 videos, which gives you a deeper dive into our trading strategies, and I introduce new strategies every now and again. Thanks for watching. Hit that like and subscribe button, and see you in the next video.